Sports had you guys were shoveling.
Oh yeah. All right, let's get going. Our skylights made the national news again. Yeah, that's what Luke was just saying. That for being out shoveling the
The two parts of the game they show is a pick and other teams scoring.
Yeah.
They didn't do anything for another. They're like, no, these guys did great.
Yeah. Yeah, it wasn't very nice of them, but oh well. Couple things. We made $677.49 today in our portfolio, so that's a plus. Market was up a little bit. That's good. Almost 0.5%, really. That's not too bad for a day. But again, you can see that the market's pretty worked up and worried about the impending impeachment hearings and whatnot. So I wanted to spend a little bit of time today. Project One, it's time to move on to our next thing, although we got a little housekeeping to do with a little bit here in the past. On the payroll, there's a couple of you. Make sure you check your feedback, because so far I actually haven't assigned too many grades because I want people to fix a few things. Minor things. Don't when you see it, don't get too upset and worried about it. They're minor things. Some people forgot to put anything in here for workers' comp. They said you got to have something there in workers' comp. Okay. Because everybody, if you have an employee, you will pay some workers' comp. Okay. Doesn't matter how safe your job is, you're still going to pay a little bit of workers' comp. They might get a paper cut. Okay, and that could lead to an infection that might cause them to have to pay out worker comp benefits. Who knows? Okay. A lot of folks, and this is kind of I don't know why they did this in the program, and I probably should just change that, but a lot of you came over, you had part-time employees, so you put some amounts in here, but the growth rate here is 10%. The growth rate down here is 20%. Those two are incompatible, so you could either, you have your choice, you could either go ahead and change this to 20%, raise their salaries, or lower these four things here to 10%, or whatever amount you chose. You don't have to use some kind of using numbers that are in there. I think Luke, for example, used 7.5%, but he changed it down below, so everything's consistently 7.5%. That's fine. Okay, it's kind of I don't like the way they put their formula in there. I should just go ahead and change the whole formula, and then it wouldn't matter what was in there. I could fix that. It makes for a little longer formula in a couple of these cells, but wouldn't be that tough. So I should do that, but I haven't. Okay. Operating expenses. I made a couple comments. There were a few of you, I think, for example, and especially on insurance, but maybe even on legal and professional. And I'm not quite through everybody's. I think I finished reviewing most of these, but and you might have left this first month blank because you put it on the startup, but then you carried it out for the first month. And in effect, what you're doing is kind of amortizing your own expenses there. That's not the way we should do it here, and I'll tell you why. Because odds are you're going to pay for this in the startup. Okay, there are very few insurance agents or insurance companies where if you were starting your business today would allow you to pay just 1 month's worth of insurance. They're going to want to get it up front, right? Okay. Legal would be even more so, right? If you went to see a lawyer and said, geez, I'd like to set up an LLC, they're going to say, okay, it's $1,500. You probably pay it before they even turn a page over, right? So that's going to come up front, okay? If you put that in the startup costs over here, I'm sorry, you got to find advertising, in prepaid insurance, I'm sorry. If you put that in the startup costs here, it's automatically going to amortize that over the first year. Okay, so let's just say, for example, your insurance you estimate is going to be $4,800 for the year. Put it all in the startup costs. when we get done, we got a couple things we got to change, but when we get done, I'll show you those changes today. It's going to show that $400 per month as an expense, and that's exactly how it'll do it right here on the income statement. It'll be right down here, amortization of startup expenses. Okay. Let me just kind of show you. It's going to be a little different right now, and I'll fix it in a second, but that's okay. I kind of want to show you. So let's say I put $4,800 in here. Hopefully it'll show up with just that. Oops. Okay. Shows $133 or $1,600. I'm gonna change that in 1 minute because of a change that I want everybody to make. Hopefully you have this open on your desktop right now. And you make this change for me right now. 2 changes on this additional inputs tab, okay, which is the 4th tab, additional inputs. This is the next part of your assignment, project 1. Scroll down until you get down to the income tax assumptions and the amortization period in years. Okay, oops. Click on that and change it from 3 to 1. Okay. That's because you have to go up then to review, unprotect the sheet, and put in the code. Yeah, I must have had fat fingers when I did mine. So. Okay, then you should be able to change it. Okay, save that. Okay, I will if I see any that get turned in like with the 3 still in there. Unless you really want to justify that to me, okay, I'll take points off immediately for that, okay. The reason for that is, generally speaking, with small business, and your guys' are all really small, okay, I looked it up even before class, the IRS allows you to expense those things in the very first year, okay, and normally you would, okay, especially things like insurance, because you're going to pay it again at the end of the year, right? You have to, okay? And so it's going to be expensed over that first year, so I wanted to change that. When I go here now to the income statement, see it changed that to $400 per month? So it does amortize that over that first year. And that's what I want to see. Okay. Back to additional inputs. Is anybody in here going to form a C corporation for your small business? A C corporation. Anybody? Okay. Then tell me how much taxes your business is going to pay. Trick question. I should make that the quiz question for the day. Because that is the quiz question for the day. Nobody knows the answer, so you all get zeros for the bonus quiz question for the day. The only entity that pays taxes, right, outside of, let me start over. The only entity that pays taxes is a C corporation. Every other entity is a flow-through. Okay, every other entity is a flow-through or pass-through, okay, whatever you want to call that, which means that the profits and losses flow through or pass through to the owner or owners. Okay, so your entities are going to pay exactly 0 in taxes. You're going to have to pay it on the personal side. It matters not either what you take out of the business. Okay, what you take out of the business in terms of cash when we get to the cash flow, that doesn't have any bearing on whether the business made money or lost money. Okay. I know sometimes that gets kind of confusing and you look at it and on, but that's the way it works. Okay, so change your tax rate to zeros unless, again, you have a compelling reason to be a C corporation, which so far I don't think any of you would want to be. And you can explain that compelling reason to me, or defend it to me, I should say, right? I would say, you know, one defense here, if you had a particular startup cost for whatever that was huge, maybe it was pre-opening salaries because you had to work for a full year ahead of time and you were paying people 50, 60, 100, 50, 200 grand, whatever it might be, that you might amortize. You can capitalize it and amortize it. But for all of us in these small businesses that we're looking at, you want to just get rid of that in that first year. Okay, any questions about that? Okay. Then we go to our sales forecast. That's the next two things. So, I'm sorry. I'm going to go back to additional inputs because I need to talk about this up here. You may or may not choose to change things here. If you look at this, and this will have an effect only on your cash flow, but your accounts receivable, days outstanding, and what they have in here as a default is this, that you're going to get paid on 30% of your accounts within 30 days. Right? It says that you're going to get paid on 30% of your accounts between 30 and 60 days, and that you're going to be paid on 40% of your accounts in more than 60 days. I don't know that that's realistic for a lot of your businesses. Okay? How fast do you think you're going to get paid on most of yours, Carl?
I would hope pretty quick.
Yeah.
I wouldn't be planning on.
Summer's gonna be over if you if you wait till after 60 days. So yeah, you could come mow my lawn all summer and then bill me at the end of summer, and I may or may not pay you, right? Okay. So you may want to adjust this depending on your business, and I might suggest that most of you would adjust this, right, depending on your business. Okay. Carl might get paid 95% within 30 days, 5% between 30 and 60 days, okay? And hopefully he doesn't have anybody that stiffs him, right? Okay? You do have an allowance for bad debt down here for people that might stiff you, right, that don't pay you at all, okay? The key here is that when you put in the amounts up here, the percentages up here, it adds up to this 100, right? If I change this to 20, it's going to, it didn't change. Oh, it did. It changed the allowance for bad debt. So it's automatically doing a default here for the allowance for bad debt to make this equal 100. Okay. So, 10% may be a little high. It depends on your business, right? Some of you may have businesses that you'd have, that high of an allowance for bad debt. Who's the one boarding animals? Is that you, Erica, or is that? Oh, no, that's somebody distant that's doing that. Yeah, they can keep the animal then, right? Put a lien on the animal and keep it. Called an adjuster's lien. Okay, you probably do the same for each year, right? So if I change this to 20%, I'm probably going to change this to 20% as well. Okay. Odds are, again, most of you are probably going to have businesses where you're going to collect more up front, right? Now you can say I got a minus 40 there, so that's not going to work, right? So I got to make it equal 100%. So I got to make this, so I might go 30, 20, 10, right? Or I'm sorry, 70, 20, 10. So I might go 70, 20, 10. Okay, I might like that. Carry that over. Boom. Make sense? Okay. Also on your accounts payable, could be similar. You might be in a business, Aaron, your business. You guys are starting out. Do you think that Cisco or Food Services of America is going to give you an account where you can pay them after 30 days and maybe for as long as 60 days? Probably not. They're probably going to want to get paid pretty close to up front. You may get in a little account at IGA or something like that you could pay out. So you may want to change this too. This may end up being more like 90 and 10. Okay. Again, it has to add up to 100%. And if you do that for the first year, you're probably going to, that's probably going to stay pretty consistent through the years. Carl, you got to fill up with gas. You're gonna put that on your credit card and pay it right away, right? Yeah. So. Okay, so that's the additional inputs. Sales forecast. Generally speaking, just put 1 in the units. There's going to be some exceptions there, but generally speaking, that's just going to be 1. Let's say I'm gonna sell widgets. Okay. I'm gonna sell those widgets for $1 each. My cost is 50 cents. So my margin is 50 cents, right? Okay. So that's my first product line. Put it in down here, right? Widgets. I'm gonna sell one. So in the first month, I'm gonna sell 2,500 widgets. It does the math for me. If I think I'm going to sell 2,500 widgets every month, then I can just extend that out and away I go, right? I can have 1, 2, 3, 4, 5, 6 different product lines. It's difficult to expand that. So if you had a real complicated menu, you know, Aaron, you might have a lot of things on your menu. You might have to try to combine some things, if that makes sense. You know, drinks. Going to average $1.50 a drink, and my cost on it's going to be 75 cents or whatever it is. Actually, the cost on pop's a lot cheaper than that. About $0.015 per ounce, something like that. So, yeah. Okay, so you might have to do some combining. If you got some questions about that, ask me, and we'll sit down and figure that out a little bit for your particular circumstances. A lot of you are just going to have 1, 2, 3 products maybe, or a service. What do you do if it's a service? Kind of the same thing, you know. If my service is one snow, that's appropriate. One snow blowing, something like that, right? Units, okay. But I might, you know, sales price. What if I do it? And I might do it, you know, units. What if it's square feet? You know, that could be my units here, right? I could put something like that in there. You know, I might charge something goofy like that. I might charge 10 cents a square foot, and my cost might be 5. I probably don't have on a lot of service things. I probably don't have cost, okay, because that's going to be figured into my operating expenses, your fuel costs, those types of things. The only cost you'd have on a service is if you had a shop and you were paying somebody. I think we talked about that with some of you guys back there. Say your shop rate was $50 and you're paying somebody $30, okay. You'd put in there your cost of goods per unit's $30 and your shop rate is $50, right? So you're making $20 for every hour that person works, right? Okay. So yeah, I might do something. I was going to change that to 0. You know, I might do something like that. My margin per unit's 10 cents per square foot. Okay. So everybody's going to be a little bit different. This is kind of nuanced here. You got to think it through a little bit. Okay, you got to get some rough ideas. You got to have in your mind maybe where you want to end up. And you'll do that by hopefully looking at your payroll and your operating expenses. That gives you a little bit of a clue, because hopefully your sales are going to be higher than that. Or your gross profit hopefully is going to be higher than that, so that you can cover those. You know, if it's a little less the first year and then it gets better second and third year, that's fine. Nothing wrong with that. Because in the second and third year, all you really need to do probably, some of you that are going to be seasonal, you might have to come down here and still make a few changes. But mostly in the second and third year, you're just going to change these percentages of what you think your growth is going to be. Okay. For those of you that have a lot of employee expense, if you did, as compared to your operating expenses, okay, you've got 20 and 30% kind of built into the pay increase for your payroll expenses, and this is only 10%. You know, sometimes that can cause some problems, right? Because your sales are only growing by 10%, but you're paying your folks 20% more and then 30% more. I've seen that turn some businesses upside down in years 2 and 3 when we're looking at this. So you might want to, you know, consider either changing what kind of increases you're going to give to your employees, or change these growth rates here to be more rapid if you think you got a good, fast-growing type of business. Any questions about that? Again, this is going to be a little nuanced. These you might have to, you know, put your hand up and let's take a look at it. If yours is a little bit different, you know, kind of plug through what you think it is and have me come take a look at it and make sure we're on the right track. Service businesses, a lot are going to have 0 for cost of goods sold. If you're manufacturing, you're going to have cost of goods sold. If you're retail, you're going to have some cost of goods sold. Okay. No questions? Okay, chapter 8, just quickly, I think problem 8.8, if I remember right. I glanced at it before I came, or this morning, I can't remember. That one, there's a couple different ways to figure that, and I think I gave you a couple different ways when I did the video for that. Okay, so don't get all stressed out when you get to it. Just kind of work on it again. If you want to plug and jump in on that one and see how it looks, and then ask me before Friday when it's due, that's fine. It might be kind of smart. I just want to give you guys a heads up on that one. It's got a couple funky things in it that you could change. You know, I looked at it the way the book had it figured, and I figured a couple different ways that I could have and would have looked at it had it been me. So, okay, no other questions? I talked way too long today, so I will quit.